So, we're looking at different ways to build trading systems, right? Using pre-built signals or robots seems like a relatively straightforward path.
True, but manual trading, relying on your own experience and knowledge, has undeniable appeal. It's about constant learning and adapting your strategies from experience. You are in the driver's seat.
While AI might lack human intuition, manual trading relies heavily on the trader's experience. But isn't that experience vulnerable to emotional pitfalls?
Absolutely. Emotions can cloud judgment and lead to poor decisions. A robot, however, can be programmed to avoid these human biases. It's a trade-off, isn't it?
So, pre-built signals and robots seem simple. But are they truly reliable? The text highlights needing to be cautious and see them as tools, not fixes.
Precisely. They can be helpful, but relying on someone else's signals or a robot's algorithms means you're not controlling the entire process. You need to be critical of them.
The speed of robots is appealing. They can make countless trades, theoretically outpacing human traders. But are they truly optimized?
Potentially. But remember, the text mentions a possible lack of optimization and the profit motive behind the robot's creation. You need to scrutinize the robot's performance data.
These signals like Tesla, buy price 203, sell price 208, seem straightforward. But how do you know the provider isn't misleading you?
Exactly. A huge market means finding a trustworthy signal provider is crucial. You need to thoroughly analyze their track record and the logic behind their signals, not just take them at face value. There's a lot of due diligence.
So, ready-made signals are convenient, but involve a substantial amount of research and testing to find reliable ones.
Precisely. A strong portfolio of signals requires constant vigilance. You must test and update signals, actively managing the mix to stay on top of changing market conditions.
So, signal providers often hide the logic behind their signals. How can you trust them without knowing the reasoning?
You can't. It's crucial to scrutinize the provider's analytics. Dive deep into their track record.
Hand signals, generated manually, seem limited in quantity. Are they worth the effort of analyzing?
Potentially, if they're from a reputable provider with a good track record. But the small volume might make it less worthwhile.
Automatic signals based on algorithms seem to generate more. What's the trade-off in relying more on algorithms?
More volume, but potentially less insight into the logic. You still need rigorous testing and analysis. You're relying on a black box to some extent.
So, automatic signals are generally more numerous than manual ones. But what about the potential downsides?
Right. While quantity increases, the lack of transparency in the algorithmic logic can be a concern. You're essentially trusting a black box and need rigorous testing.
Copy trading seems incredibly convenient. You just copy someone else's trades. What's the catch?
The key downside is the lack of control. You're essentially letting someone else manage your money. That can be risky.
Alert seems safer, since you still decide what to do. But is there any hidden risk?
Alerts are relatively safe. You get a prompt to act, but you're still in control of the position size. Still, you should research the provider to avoid issues.
Account management takes it a step further. You hand over full control to a provider. What's the trade-off?
It's tempting to have someone do all the work, but be extremely wary. It likely involves a percentage of your profits and comes with high fraud risk.
Free signals? What would be your thoughts?
Unfortunately, you typically get what you pay for in the case of free signals, usually the lower quality compared to their paid counterparts.
So, account management puts complete control in the provider's hands. What's the catch?
Potentially high rewards, but also a significant risk of fraud. A percentage of your profits will likely be taken, and thorough research into the provider is essential.
Free signals seem tempting, but the text says they're often lower quality. Why is that?
Providers aren't motivated to share high-quality signals for free. They often lack the thorough testing and refinement associated with paid signals.
Creating a portfolio of signals from different providers sounds like a lot of work. What makes it challenging?
Constant analysis and testing are necessary. You need to constantly add new and remove outdated signals. It's a significant time commitment.
The text highlights the time commitment to signal-based trading systems. Is it really worth the effort?
The apparent simplicity can be deceptive. Building and maintaining a portfolio requires a substantial investment of time. Returns may not justify the effort.
So, algorithmic trading robots are readily available. But are they truly worthwhile investments?
The sheer number of robots raises questions about their true effectiveness. The creators likely prioritize profit from sales over maximizing trading performance.
What about the price of these robots? Is it a barrier to entry?
Indeed, the price can be high. You need to consider not only the purchase cost but also the effort needed to ensure the robot performs as advertised.
How challenging is it to evaluate these robots before purchase?
Analysis is crucial. Reviews aren't enough. You need to examine the indicators yourself to understand the robot's performance. The sheer number available makes it a substantial task.
So, while robots offer convenience, they come with potential downsides. What are the key factors to consider?
The return on investment must be carefully evaluated. Transparency in the robot's algorithms is crucial, and a history of consistent performance is a must.
The text mentions robots being readily available, but questions their true value. What's the core issue?
Profit from sales likely takes precedence over maximizing the trading performance of the robots. While some may work well, proving a robot's effectiveness is tough.
The price of these robots is noted as a factor. What makes this a concern?
The price represents an investment that needs to be recouped through consistent profitability. Finding a consistently successful robot is difficult.
With thousands of expert robots available, how does one approach evaluating them?
Thorough analysis is essential. Reviews alone aren't sufficient. Direct examination of performance indicators is vital.
Despite the potential pitfalls, robots offer convenience. What crucial points need to be considered?
Return on investment, algorithmic transparency, and a verified history of consistent performance are paramount.
So, having many robots in a portfolio doesn't necessarily equate to success. What's the deeper implication?
It suggests the focus is on quantity rather than quality. The real value lies in finding robots that consistently perform well, not just having a large collection.
Different algorithms and features are mentioned. What specific considerations arise?
The logic behind decision-making, money management strategies, trading frequency, and the methods used all affect performance significantly.
What about the importance of performance data included with the robots?
Analytical data is crucial for evaluating a robot's potential. Understanding its history is key to predicting future success.
You mentioned performance indicators. Can you elaborate on some key ones?
Expected value, profit factor, and various drawdown metrics are essential. These provide a basis for assessing the robot's long-term potential.
Profit factor is crucial. What exactly does it tell us about a trading strategy?
It shows the ratio of profits to losses. A high profit factor indicates a potentially effective strategy.
And how does absolute drawdown differ from relative drawdown?
Absolute drawdown shows the total change in funds, while relative drawdown expresses the largest loss as a percentage of the previous high.
Maximum drawdown is mentioned too. Why is that important?
It highlights the maximum loss a strategy has incurred. A smaller maximum drawdown is better.
The recovery factor, what does it measure?
It measures how quickly a system recovers from losses. A higher recovery factor suggests quicker recovery.
So, these indicators provide a multifaceted view of a robot's potential. What's the overall implication?
They offer insights into a robot's stability and potential profitability over the long term.
So, different time frames like long-term, medium-term, and short-term strategies exist. What are the key differences?
The length of time a position is held significantly impacts risk and potential rewards. Short-term strategies are faster but riskier.
You mentioned arbitrage and scalping as short-term strategies. What distinguishes them?
Arbitrage robots trade across multiple exchanges, while scalpers operate on a single exchange. Both aim for very quick trades.
What's the practical implication of the difference between automatic and semi-automatic systems?
Automatic systems require no human intervention, whereas semi-automatic ones need constant oversight. This affects their complexity and cost.
Why might semi-automatic systems require more human involvement?
They often have less built-in functionality and may need human input to manage specific aspects of trades, such as position size.
So, expert advisors based on the martingale principle. What's the core concept?
It's a money management system that doubles the position size after each loss. Profits then supposedly cover losses and return to the original size.
But that sounds risky. Why is the martingale principle considered problematic?
It's highly prone to losing all capital with prolonged losing streaks.
Trend and oscillator systems, are they based on technical analysis?
Yes, they utilize technical indicators for trading decisions.
In non-indicator systems? What's their defining characteristic?
These systems don't rely on technical indicators. They might use news analysis or social media sentiment for trades.
For short-term signals, the average holding time is important. Why is a very short holding time, less than a minute, problematic?
Scalper and arbitrage signals often have holding times under a minute and are extremely sensitive to trading platform delays.
So, signals with very short holding times are difficult to execute effectively?
Yes, potentially. Latency can prevent timely execution.
So, very short holding times and signals are problematic due to latency. What about excessively long holds?
Long holds might indicate a flawed trading strategy. The robot might be trying to recoup losses, leading to delayed exits.
The martingale system is a significant red flag. Why is it so dangerous?
It's fundamentally flawed. Repeated losses inevitably lead to capital depletion.
How can you spot a martingale system just by looking at the balance and funds charts?
Large discrepancies between the balance and funds charts, coupled with an increase in open positions and a decrease in closed positions, are indicators of martingale.
So, consistent growth in both charts is a good sign, right?
Generally, yes, it suggests a more stable system. Fluctuation is inevitable, but an overall upward trend is a positive sign.
What factors should be considered when evaluating algorithmic robots?
Expected value, profit factor, drawdowns, absolute and relative, and recovery factor are key indicators.
Can you elaborate on the importance of the recovery factor?
A higher recovery factor signifies the system's ability to recover quickly from drawdowns.
So, the balance and funds charts should be close together for a reliable system?
Yes, a consistent, growing proximity suggests a more stable system.
What about the open and closed position count? How does that indicate reliability?
A uniform alternation of open and closed positions points to a reliable system.
Why are automatic robots generally considered more reliable than semi-automatic ones?
The human factor is removed, eliminating emotional trading biases.
But automatic robots are more complex to develop?
True, they involve more sophisticated algorithms and often command higher prices.
Why are trend and oscillator systems dominant in the algorithmic market?
Their logic is easily programmed using technical indicators, making them more readily adaptable.
How does the ability to trade multiple instruments affect robot reliability?
The ability to trade diverse instruments suggests a broader adaptability to market conditions and greater reliability.
So, a robot trading multiple instruments is potentially more reliable?
Yes, it implies a less tailored approach which tends to be more resilient in the long run.
Total control over an algorithmic system is crucial. Why is monitoring so important?
To prevent unforeseen issues and halt trading if a problem arises. This could save substantial losses.
Trend and oscillator systems dominate the algorithmic market. Why is this the case?
Their formulas are easily incorporated into programs due to their reliance on technical indicators.
The ability to trade different instruments is a plus for robots. How does this relate to reliability?
Trading diverse instruments suggests the robot is less tailored to a specific market situation, boosting its resilience over time.
So, a broader scope of tradable instruments is a positive for reliability?
Yes, it indicates the system isn't overly dependent on specific market conditions.
So, a robot's ability to trade multiple instruments suggests reliability?
Yes, it implies the robot isn't overly reliant on a specific market condition, which improves long-term performance.
Why is diversification of trading robots a good strategy?
Diversification reduces risk by spreading investments across different systems with various approaches.
This approach is similar to a signal portfolio, right?
Precisely. It's about combining different strategies to potentially increase overall returns.
But isn't this method expensive?
Yes, purchasing and maintaining a diverse portfolio of robots generally involves higher costs.
Why do specialized services often fall short for complex strategies?
They usually lack the flexibility to fully implement unique or very intricate trading logics.
So, what's the next step if specialized services aren't enough?
If you need a highly customized approach, independent development or hiring developers is the next step.
So, these specialized services are good for basic trading robots, but what about intricate strategies?
They're limited in their ability to handle complex logic. More advanced strategies need more programming power.
What kind of programming languages do some of these services use to expand functionality?
Some services offer Python or C#, allowing for more elaborate algorithms.
Why is learning a scripting language helpful for using these services effectively?
It lets you customize the trading logic beyond the basic functions offered.
So, you need programming knowledge to truly unlock the potential of these services?
Yes, scripting languages are crucial to adapt the tools for unique trading needs.
What's the difference between a step-by-step robot builder and a full-fledged programming solution?
The builder focuses on assembling predefined parts, while programming gives complete control over the system.
So, the step-by-step approach is helpful, but programming ultimately gives more flexibility. Is that fair?
That's right. Programming is necessary for truly unique and customized trading systems.
So, these constructor services, while offering a learning environment, might not be enough for truly unique ideas?
Exactly. They're great for basic systems, but if your theory requires something outside the standard toolkit, you need to move to independent development or outside help.
Why is creating your own system advantageous compared to using pre-built solutions?
You gain the freedom to test any trading theory without limitations imposed by predesigned functions. Your options are truly limitless.
The process of independent development is described as creative and unique. How so?
You're not restricted to any specific language or predefined framework, so the path you take to build your system is up to you.
Do you think that testing a single strategy approach is appropriate for all ideas? Or are there more complex cases?
It's good for simple theories, but more complex, comprehensive systems require more advanced development.
How would one implement a theory, say, that stock prices are influenced by social media sentiment?
You'd need to build a parser that analyzes social media mentions, identifies trends, and produces trading signals based on that analysis.
Is there a potential drawback to the independent development route?
It can be very time-consuming to build a system from the ground up, especially with complex ideas.
So, independent development isn't just about one approach, right? It's a spectrum of possibilities.
Precisely. Adding or removing features fundamentally alters the system, making distinctions somewhat arbitrary. Different development paths emerge.
Let's say I have a single trading strategy. Is that a straightforward path, or are there complications?
A single strategy can be implemented quickly. You focus on the core logic and testing, though optimization might still be a concern.
What are some pitfalls in the single strategy approach?
Understanding how strategy parameters influence performance is crucial. A lack of optimization might hinder overall effectiveness.
So, is there a method to systematically evaluate the effects of different parameters?
The brute force method is one approach. You set a range and test variations, but it can be time-consuming for many parameters.
Does the complexity of the theory matter for the single strategy path?
The method works well for simpler strategies. More complicated theories demand more thorough testing.
If I need to find the optimal parameters for a complex strategy, are there better approaches than brute force?
Yes. More sophisticated optimization algorithms might be needed for better parameter exploration.
So, focusing on a single strategy seems fast but might miss crucial optimizations?
Precisely. You get a working system quickly, but understanding how to fine-tune it for optimal performance is a significant hurdle.
How would you address the issue of parameter optimization in this limited approach?
The brute force method can be used to test various parameter combinations, but it's inefficient for large numbers of parameters.
What are some alternatives to brute force for broader parameter exploration?
More advanced optimization algorithms are necessary for complex strategies. These can systematically explore the parameter space more efficiently.
Are there any additional considerations for testing a single strategy besides parameter optimization?
You should also consider the robustness of your strategy. How well does it adapt to changing market conditions?
How do you test the robustness of a trading strategy when you only have a single strategy in place?
Backtesting on historical data can give you an idea, but you need a large and diverse dataset. Also, the results may not be completely reliable.
So, backtesting isn't a perfect solution, even for a single strategy?
No, it's an important tool, but not a complete solution. Real-world market conditions can differ significantly from historical patterns.
So, this single strategy has fixed parameters. Is that a good or bad thing?
It's quick to implement, but you might miss the optimal parameter values. Testing is essential.
Let's take the example given. How would the brute force method apply to adjusting the parameters?
You'd systematically change the values of BBW, WMRA, and RSI and see how the performance metrics change.
Would you change them all at once or one at a time?
You could vary them individually or in combinations. The goal is to identify the optimal values for all parameters.
What are the benefits of varying the parameters systematically?
You can build a clearer understanding of how each parameter impacts the overall performance of your strategy.
If this systematic approach is so good, why not always use it?
It works well for a small number of parameters, but for a complex strategy, it could be too time-consuming.
So, understanding parameter impact is valuable, but the brute force method is limited. Are there other ways?
For complex strategies, optimization algorithms are often more efficient. They can search through the parameter space in a more structured way.
What factors should I consider when deciding if brute force is suitable?
The number of parameters in the strategy. With few, brute force might suffice. Many would require more sophisticated methods.
So, brute force works well for limited parameters, but time becomes a major factor with many parameters.
Exactly. A small number of parameters allows for manageable testing. However, complex strategies quickly become computationally intensive.
How can we account for the computational cost when dealing with a large number of parameters?
Sophisticated optimization techniques become crucial. They allow for more efficient exploration of the parameter space.
What are some of these optimization techniques?
Genetic algorithms, simulated annealing, and particle swarm optimization are examples. They can handle a larger number of parameters and constraints.
Are there any downsides to using optimization algorithms?
They can be more complex to implement and may not always guarantee the absolute optimal solution.
Beyond just parameter optimization, what else is important in a trading platform?
A well-rounded trading platform should also include tools for backtesting, risk management, and potentially for live trading.
How do these features work together in a comprehensive system?
Testing with historical data, along with optimization techniques, helps determine the best parameters. Risk management ensures that the strategy can withstand market fluctuations. Live trading then tests it in the real world.
So, a complete trading platform is more than just a single strategy?
Absolutely. It's a dynamic system incorporating testing, optimization, and risk management tools for the strategy in question.
Is there a trade-off between the complexity of the system and the potential profit?
Yes, a more complex platform with sophisticated features usually requires more time and resources, but the potential for superior results from a refined strategy may be worth the effort.
Building your own exchange for testing is a significant undertaking. Why go to such lengths?
It allows for complete control over the environment. You can test very specific theories, like the one about social media impact on stock prices.
What about the practical limitations of building a full trading platform?
It demands significant time and programming expertise, but it provides unmatched flexibility. Testing custom algorithms is essential.
What are the core components of a robust testing environment in such a system?
Optimization modules, backtesting tools, and real-time trading simulations, alongside money management modules.
How do these components collaborate?
Optimization refines strategies using backtesting, simulations reveal weaknesses, and real-time trading validates it in the actual market.
What about the trade-offs inherent in this approach?
High development cost is balanced against potentially superior results from highly tailored strategies. Your customized environment could yield unforeseen benefits.
Testing unusual ideas like social media sentiment affecting stock prices or stock correlations is possible with independent development.
Absolutely. A custom system lets you rigorously test unconventional strategies, unlike pre-built solutions.
But hiring a developer also offers a path to automation.
Correct. If a trader lacks programming skills, outsourcing development can free them to focus on strategy refinement.
What are the trade-offs involved with hiring developers?
Sharing potentially profitable ideas with others is a risk. Protecting intellectual property and meticulously defining requirements are crucial.
How can intellectual property be protected in this scenario?
Contracts and clear technical specifications are essential to avoid misunderstandings and protect your ideas.
Are there financial risks with hiring developers?
There's the risk the development costs won't be recouped if the final system doesn't yield profits. Careful planning is essential.
Finding the right developer is important.
Indeed, reputation and experience matter. Companies often offer more protection for your intellectual property compared to freelancers.
Hiring a developer for a trading system seems like a shortcut. But is it truly efficient? It takes time to find the right person, right?
Yes, it's a crucial step. If you lack programming skills, outsourcing development is often a better path than spending months learning.
But aren't there significant risks associated with handing over a potentially profitable idea to a third party?
Absolutely. Sharing your strategy with someone else creates a competitor risk. You need to protect your intellectual property clearly.
What's the best way to safeguard your intellectual property when hiring a developer?
Clear contracts, outlining the scope of the work and intellectual property ownership, are essential. Detailed technical specifications are key.
Are there any financial risks associated with this approach?
Yes, there's always a risk the development cost outweighs the potential profits. You must carefully evaluate the project's potential return.
Finding a reliable, experienced developer seems challenging. How do you evaluate a candidate?
Experience and a strong reputation are important. Hiring a reputable company often provides better protection for your intellectual property.
A contract might help, but it's not a guarantee. Trusting a developer's word isn't wise. Sharing only part of your idea could lead to a flawed system.
Precisely. Detailed technical specifications are vital. They ensure the developer understands your exact vision.
But even with meticulous plans, there's still a risk the project might not be profitable. The development costs could outweigh potential earnings.
Absolutely. Thorough cost-benefit analysis is crucial before investing. Understanding the potential return is key.
Where do you find a developer with the right experience? How do you navigate the risk of finding the wrong person?
A reputable company often offers better protection for your intellectual property. Their established track record is a significant advantage.
Is a company's reputation the sole indicator of reliability? What other measures exist?
Portfolio reviews, client testimonials, and references can supplement reputation. Verify their past projects for similar complexities.
A good developer is hard to find. Is there a method to gauge a developer's competence quickly?
Yes, researching the developer's expertise in relevant technologies is essential. Look for a proven track record in creating trading systems.
A company might seem safer, but their services come with a higher price tag than freelancers. Is that a fair trade-off?
Potentially. A company's reputation often translates to greater protection for your intellectual property. It's a calculated risk weighing cost against security.
Beyond reputation, how can you assess a company's competence in developing trading platforms?
Look at their portfolio of previous projects. Have they built similar trading systems before? Are there testimonials or references available?
If the company has done work in this area, how do you determine if their work is up to par?
Verify the quality of their work. Look for evidence that their systems have consistently performed as expected. Check client feedback for quality of service. Check out the systems they've built.
My approach is to build it myself. It's time-consuming, But is it more efficient in the long run?
Time investment is key with a self-built system. You retain full control and can tailor it to your precise needs and specific strategies. However, you take on the entire development process. There is a potential for faster development using a third party if time is a concern.
What's your opinion of the risk of choosing an approach that involves time investment in developing a trading system, rather than a quicker, but potentially riskier, approach of hiring a third party?
The time investment of a self-built system is significant. You could save time by outsourcing, but risk intellectual property theft and potential project failure. The time-intensive approach is more hands-on and customizable. You will have full control of the strategy and execution. You will know exactly how it works.
Many traders focus on extremely profitable strategies, overlooking those with modest returns. It seems counterintuitive, but why is this common?
Perhaps the allure of quick, substantial gains overshadows the potential of consistent, moderate profits. It's a human tendency to chase the highest possible reward.
If a super profitable strategy is unlikely, wouldn't a diversified approach with multiple modest strategies be more practical?
Exactly. By focusing on strategies with smaller, but consistent returns, you're more likely to accumulate profits over time. This approach scales better.
A strategy with 0.5 to 1% monthly return used in hundreds of situations. That's a compelling idea. How does this approach mitigate risk?
Diversification lowers the risk. If one strategy falters, the others can still perform, reducing the overall impact of a bad result.
So, instead of chasing a mythical unicorn strategy, you're essentially building a robust portfolio of reliable but smaller strategies?
Yes. It's a more pragmatic and less risky path to potentially significant long-term gains. Building a portfolio of dependable, consistent strategies is more likely to produce positive outcomes compared to pursuing singular, high-risk, high-reward strategies.
So, focusing on numerous, smaller strategies rather than one massive one seems more sound?
Precisely. Finding consistently profitable smaller strategies is likely easier and more sustainable than seeking the elusive super profitable one.
How does this independent development approach handle the inevitable need for updates and improvements?
It's an ongoing process. Continuous improvement and adaptation to market changes are crucial. A constantly evolving system is vital for long-term success.
Is this approach inherently more time-consuming than relying on pre-built systems?
Absolutely. Building a system to discover and manage multiple strategies takes considerable time and effort, a key trade-off in this approach.
How can a system reliably and automatically find profitable strategies, particularly those with smaller returns?
Algorithms are crucial. The system needs to be designed with sophisticated algorithms for screening and evaluating potential strategies. Testing and backtesting are essential for reliable identification.
Does this approach account for the variability in the performance of smaller strategies? And how does it manage potential losses?
Yes, risk management is integrated. A key aspect is diversification. A portfolio of strategies should help mitigate potential losses within smaller strategies.
This approach sounds exciting, but is it truly sustainable? Continuous improvement implies constant work, which can be daunting.
Yes, it's a demanding, ongoing process, but the potential rewards from constant refinement and adaptation are significant, potentially leading to long-term success.
What about the practical implications of this constant updating? How does one balance continuous improvement with the demands of actual trading?
Effective time management and prioritizing tasks are crucial. A well-structured system that allows for periodic review and updates is needed.
Given the constant evolution, how does this approach compare in terms of risk to other methods? Is it inherently riskier?
While it requires ongoing effort, the diversification aspect of managing multiple strategies mitigates risk. A well-designed system should perform consistently and provide a reliable income stream.
Relying on signals or pre-built robots has clear drawbacks. Trusting someone else's expertise without understanding their logic is risky.
Indeed, you're essentially outsourcing your trading decisions, which can lead to unexpected performance. Unforeseen problems in the algorithm may also occur.
Independent development, while potentially risky, offers more control over the process. But it requires significant time and effort to develop unique strategies from scratch.
Correct. Building your own system gives you complete control but takes more time and resources. You need in-depth knowledge of the market and programming, while relying on signals or robots avoids such demands.
What are the trade-offs between using pre-built systems and creating one yourself?
Pre-built solutions provide instant access and potentially save time, but with a loss of control. Custom strategies give maximum control but need more time, skills, and testing.
Is the risk involved in using pre-built algorithmic robots higher or lower than manually creating and testing your own strategies from scratch?
Both have risks. Pre-built systems have an unknown, potentially hidden, set of parameters. Developing your own exposes you to the risks of your own potential mistakes. Proper testing and evaluation should mitigate many risks.
Hiring external developers seems appealing for complex systems. However, the difficulty in finding skilled developers and potential conflicts over intellectual property are significant concerns.
Indeed, finding developers with expertise in this field and aligning on project expectations are crucial. However, the potential for a truly customized system, tailored to specific needs and strategies, is a major advantage.
The cost of developing a custom trading system is likely substantial. How does this compare to other methods in terms of ROI?
The return on investment with a custom system is uncertain. It depends heavily on the effectiveness of the strategies developed and the time required for their successful implementation.
Independent system development demands substantial time and resources. Is this approach suitable for everyone?
This method is not for everyone. It demands extensive expertise in programming, market analysis, and project management. Alternative methods may be more suitable for those without these resources.
Comparing the independent development approach to pre-built solutions, are the potential benefits worth the significant investment of time and resources?
The advantages of complete control and customization are substantial, but they come with a hefty time investment. The question becomes whether the potential return on this investment justifies the time commitment.
What are the key considerations when weighing the pros and cons of this method of independent system development?
Key considerations are the developer's expertise, the comprehensiveness of the project, realistic timelines, and a sound cost-benefit analysis. Finding the right balance is essential.
Developing a trading system based on ready-made signals seems simpler, but constant analysis and testing of signals from various providers is necessary.
Exactly. The simplicity is deceptive. Maintaining a portfolio of signals requires ongoing effort and potentially high costs to stay profitable.
Using third-party algorithms offers a way to avoid initial development, but finding a consistently profitable algorithm can be challenging.
Correct. The market is saturated with robots, and many are unlikely to deliver the promised results. Thorough analysis and testing are crucial before committing to anyone.
Specialized services for building trading systems might offer a middle ground. What are their limitations?
These tools can be useful for basic strategies, but they often lack the flexibility for very sophisticated or innovative ideas.
What about creating your own trading platform? It seems to offer the most customization.
Absolutely, but this path is the most demanding, requiring considerable programming skills and time to test.
How does the testing a single strategy approach compare to developing a more complex platform?
Testing a single strategy is quicker but lacks the potential for optimization and broader testing. A platform allows for more comprehensive evaluation.
What are the key factors influencing the choice of approach for developing a trading system?
Resources, technical skills, risk tolerance, and the desired level of customization are key factors.
Manual trading, while relying on experience, is prone to emotional errors. How does this compare to automated systems in terms of consistency?
Automated systems eliminate emotional biases, leading to greater consistency, but they lack the intuition and adaptability of skilled human traders.
Ready-made signals offer ease of implementation, but supplier reliability and signal logic are crucial. What are the potential risks associated with this approach?
The risk lies in relying on potentially flawed or misleading signals. Thorough research and validation are essential.
Third-party algorithms seem tempting to avoid development time. However, their limitations and potential hidden costs are significant. What are the significant drawbacks?
The potential for unreliability and the significant cost associated with acquiring, testing, and maintaining a profitable algorithm are key drawbacks.
Specialized services offer a way to build trading systems without extensive coding. However, what are their limitations?
They are limited in their ability to accommodate sophisticated or highly customized trading strategies.
Independent development is attractive for unique strategies, but requires significant time investment. What factors influence the practicality of this route?
The availability of time, technical expertise, and the level of complexity of the desired system are crucial factors.
How does the brute force method fit into the overall strategy development process, especially when dealing with numerous parameters?
The brute force method helps analyze the impact of parameter changes, but it becomes impractical with many parameters, necessitating alternative optimization strategies.
What are the benefits and drawbacks of diversification in a portfolio of trading robots or signals?
Diversification reduces risk but demands extensive management and analysis to achieve optimal results.
What are the key criteria for evaluating the success of a trading system, regardless of the development approach?
Profitability, risk management, and consistency over time are crucial criteria.
Hiring third-party developers can implement complex systems quickly. But what are the risks involved?
Sharing your trading idea carries a risk of losing your intellectual property or attracting competitors. Carefully defined contracts and specifications are crucial.
My approach focuses on independently developing a system for automatically searching and testing diverse strategies. What's the biggest drawback?
The significant time investment is the main drawback. Constant development and improvement are ongoing.
How does the testing a single strategy method differ from the comprehensive platform approach in terms of potential profitability?
A single strategy might be quick to develop but could miss out on significant profit opportunities by not optimizing for a broader range of market conditions.
What are the key considerations for successful independent system development, beyond just technical skills?
A clear understanding of the market and thorough testing are essential, alongside a robust risk management strategy.
How does the concept of diversification apply to trading system development, whether using signals or algorithms?
Diversification allows for the reduction of risk and potential optimization by combining different systems or strategies.
What are the long-term implications of choosing a particular approach to trading system development?
The long-term implications depend heavily on how well the chosen approach aligns with your trading goals, resources, and risk tolerance.
The text mentions expert advisors based on the martingale principle. Why is this a risky strategy?
Martingale systems are inherently risky due to their compounding loss potential. A prolonged losing streak quickly wipes out the capital.
Are trend and oscillator systems generally more reliable than other algorithmic approaches?
Trend and oscillator systems, often based on technical indicators, can be reliable if well designed, but market conditions can change, impacting their efficacy.
What specific steps can one take to improve the reliability of an algorithmic trading system?
Rigorous testing across diverse market conditions, continuous monitoring, and adjustments based on performance feedback are essential.